Good evening to all of you. Thank you very much for joining us and giving me this opportunity to speak about markets, what I have as an outlook on the markets, and also on the fund that I manage, the HSBC Small Cap Fund. Let me first give you my insights or my views on the markets. I think the markets have been very strong over the last few, couple of months at least after a correction of about 10% between December and March that we saw. To refresh your memories, I think 2021 was a great year with fantastic returns from the starting with the recovery. 22 had all the challenges starting with the Ukraine war and then the runaway inflation, supply side constraints on a lot of things, disruptions all over, and therefore markets and already which had run up quite a bit had to take a pause. And since I think October of 2021, markets have been struggling to really go beyond a point, beyond a level, and has been within a band. The good news is that we have not really corrected so much as the rest. Some of the other markets have. The Nasdaq has corrected more than 35%. We've really not had that kind of a fall, and that is largely because our fundamentals are far stronger. As probably I would have mentioned in calls earlier as well. We are now seeing parallel worlds with one side of the world really struggling with higher inflation and lower growth, which is the Western world, the more advanced world. And on the eastern side, you have better growth prospects, not so much struggle with respect to inflation, interest rates already having kind of peaked. So we are seeing two different worlds. And India has also been one of the better economies, or one of the best economies in terms of prospects, in terms of growth, and therefore we have really outperformed most markets. So I don't think I need to spend much time in explaining why India has really outperformed. But the thing is that this period of risk aversion, which has come in ever since October 2021. The premium that India had over the rest of the markets, especially the emerging markets, have come off from the peak level. So, India had a significantly high premium. It really rose to a very high multiple and then percentage, and then has now corrected to almost equal to the long-term average. But having said that, I think our markets have done fairly well since the I think last July or August or so, and more importantly, and there was a bit of a correction. I think I mentioned 10% between December and March, and since then, I think from March year end onwards, it's been a reasonably good rally, which has taken the index almost, or the Nifty almost near the previous highs. And at these levels, again, the questions are in everybody's minds as to whether there is enough strength to really carry forward this move. I think the key considerations here are the interest rate, the interest rate cycle, how fast do you get to the peak, and how soon you will get a cut in interest rates, and once that starts, how much of cuts you will get on a consecutive basis. Also, I think the questions on growth and the recession that is expected by a large part of the world, in the US. I think that those questions also getting raised. We haven't seen too much of very poor numbers or recessionary kind of data, but I think as we go forward, the numbers are going to deteriorate, and you will get to that point. So those are considerations from the global side. But I think on the domestic front, the rural economy, which has been struggling for some time, is now expected to come back on track. And whether that slowdown can change fast enough, there's a monsoon prediction which is not really so good, with the prediction right now being close to average or maybe less than the average. So we'll need to see whether that recovery takes place, strong enough as we go into the next financial year. As we've already moved into the next financial year, but as we go forward into the year, we also are getting into these election modes in various states, and then finally the union election. So I think all of these things are in the minds of investors, and to that extent, I think the volatility is likely to continue for some more time. I think we'll have to live with that. But my sense is that markets have already started pricing in or looking at the scenario beyond the interest rate peak and the recessionary data, etc. And I think the markets are now trying to factor in what can come beyond that, and that is giving it far more strength, in my view. Obviously, the flows have also improved in the last few months. FIs have been once again investing heavily in the Indian markets. The domestic money at the retail end continues to pour into the market. So we have, and on the fundamental side, I think earnings has been fairly robust, I would say, after a very strong FY21 and 22 was a slightly subdued year. 23 actually has been about, I think the expectations about 10% for FY23. 22 was a great year. Sorry, 23 was a great year. 22 was a great year over 21. 23, the expectations about 10% on a year-on-year basis. I think the view currently is that FY24 earnings growth for the Nifty would be somewhere in the range of 15-16%. Earlier, the expectations were higher at more than 20%, but that has got cut down given all these factors, higher inflation trends that we have seen, till now. So I think the earnings growth of 14-15% or there or somewhere there is not a bad number. So this is a fairly good trajectory for earnings. I think the growth is likely to come back again stronger, given that commodities have corrected significantly. So the pressures are off on the input cost side. You also have the interest rate cycle, kind of reversing over time. I think the expectation currently is that it will happen sometime in the by end of the year or maybe in the first half of next calendar year. So I think with that, and there is an expansion that is happening in the economy, the domestic economy. There's a lot of investments that are going on currently into infrastructure creation. There's a huge thrust from the government side. Significant number of orders have been given out in FY23. It's a record year in terms of order awards. Project announcements have also been growing at a fast pace, and within that, I think the manufacturing space has seen the bigger share, or it has taken a bigger share in terms of project awards. So I think that all of that augurs well for the economy. The near-term growth driver is clearly going to come from infrastructure and investments. Over a longer term, or the medium to long term, of course, consumption is also likely to kick in with our per capita incomes rising beyond $2,000. I think the J curve in terms of consumption is likely to hit us over the next few years. So there are strong drivers for the economy. Therefore, strong drivers for earnings growth as well. And I think that is the reason why we are talking of the small cap fund at this point in time. We've had a lull for some period of time. The 18 to 20 period was quite bad, and since then, the growth has picked up. 22 calendar year was bad again for the mid and small caps, and then we've started gaining again. So let me just take you through some slides that I have on the fund, and within the presentation, there may be some that I can share on the market outlook as well. Okay, what are small caps? Of course, the overall definition that has been given by SEBI is very clear. Large caps are the top 100, mid caps are the 101st, 250th in terms of market cap, and small caps are the ones which are beyond the 251st in terms of market cap. These are largely, or these are in very these are small companies, emerging companies. We call them emerging businesses. Uh, in the past, the fund used to be called L&T Emerging Businesses Fund, which merged into the HSBC Small Cap Fund. So we used to always call this emerging businesses segment, and for a reason. I think these are companies that are evolving. They are in the early stage of their life cycle. They are, therefore, pearls in my mind, which needs to be identified, and you need to remain patient for it to really grow into much bigger sizes. The advantage here is that these companies, since you're catching them very young, there is a better growth potential from these over time, and that is what we are trying to capture. Compared to the mid and small caps, therefore the alpha generation potential is also higher here. How do we define emerging businesses or small caps? See, emerging businesses are typically small-sized companies which are, as I mentioned, in their early stage of their life cycle. Um, uh, they wouldn't have, history beyond, let's say, 10, 15 years. Some of them have slightly more, but they are small in size. These businesses have potential to grow their revenues and profits at a higher rate compared to the rest of the market, given that they are small in size and the opportunity as it comes. And if they are driven by good people, then obviously they can grow, especially in cases where in businesses where the runway of growth is fairly long, which is what we are trying to identify and invest in. Management teams of such companies or these kind of small businesses are hands-on, which is always required, given that these need to be nurtured and taken to the next level. And therefore, I've always maintained that while looking at these kind of companies, the quality of management is prime, and once you have that right in terms of the integrity of the people behind the show, the ability, the vision, and the drive of the promoters, the energy levels that they bring to the table. If that once you're convinced with that, I think a lot of your work is done. Obviously, the business should have a long runway of growth, which is also required for you to make money. So once these two, parts of the equation are there, then I think more than 70% of your work is done. The remaining is obviously market conditions and valuations and things like that. So you can wait, you can, that is a, more of a subjective thing. You can decide, but these can, these are companies where management teams are extremely critical, and you need to focus on them. So they typically fall in segments like companies which are in evolving industries. So the industry itself is in a very nascent stage and is building up. I can give you an example of let's say chemicals. Some time ago was a nascent industry for India. We were largely producing these products for the Indian markets. Now, over the last few years, that has changed. We are exporting. We are supplying to a large part of the world. We have taken market shares from China and elsewhere, and therefore become a significant size in terms of the overall global industry. So that's one example of an evolving industry, or a industry which was in a nascent stage, becoming much bigger. There could be other examples. There are examples of some of them which are currently nascent and maybe growing over the next few years into much bigger size. You could also look at even sectors like real estate, for example, for the size of the population that we have, for the need of this population. That there is a huge shortage in terms of housing in this country. Given that scenario, the market caps of companies listed, that if you analyze, you will find that there are not too many large cap companies in the real estate space. So clearly, this is again a segment though we are familiar with this industry for a long period of time. This industry is again something that is in a very nascent stage. It is just evolving. Regulations have now come in. There is consolidation that is happening, and it is evolving. I can say that in over 10 years' time, or a long period of time, these companies are going to grow and become much, much bigger. I'm talking of the better run companies within this sector. um, these are, smaller players in it could also be smaller players in larger industries, catering to niche segments. So in a you know reasonably large industry, you could have some niche segments which are getting addressed by, some of these smaller players. So they offer a good opportunity, because some of these niche segments may not be of interest to the larger companies, and therefore these companies also will continue to grow. For example, some of the auto ancillary companies, it may uh, look as if, the auto OEMs also can do the same job, but they may not be really interested in doing this with the scale and size that they have. This kind of a business really may not be economical for them to really pursue. So that gets anyway outsourced to the ancillary company, and therefore an ancillary company grows on the back of that OEM. So this is a segment where these smaller companies are in niche segments, and they have a runway of growth, because the industry at the user end is growing, or will have a reasonably high or long runway of growth. Of course, there are also companies which are growing by taking market share from the unorganized space. I think one of the key themes that we have seen over the last few years in India has been the shift of market share from the unorganized segment to the organized segment. And companies that have been able to take advantage of this have grown faster. They have done much better in this period and have been resilient. We have, multiple examples of that, and I think this is a trend that we are likely to see as we go forward as well. Why small caps? I think I've mentioned that these are potentially higher alpha generators given their size, they put the prospects that they have for growth. If you look at the chart on the left hand side, while they provide growth, they also provide, in the longer term, some I mean, this category is, if you have held on for a long period of time, the probability of making negative returns as you go, longer and longer in terms of your the time horizon for your investments. I think the probability of making losses have been lower. So this is the return distribution of small cap funds. This is the return. We've taken the returns of the small cap funds as an average of funds within the respective category. This is for the period from 1st January 2005 to 31st December 2022. As you can see, the probability of making a loss in 10 years, actually, from the category average, is actually 0%. So upwards of 7 years, the category has seen quite low percentage of negative returns, and the percentage of higher returns. Also, you can see, I think, on a 3-year basis, the 36% of time these funds have given, or the average has given, more than 20% return. So there is stability as well, though you may get volatility in the shorter term, in the near term. The longer you hold, I think the probability of making money and probability of making higher returns or higher alpha is clearly there from this segment. So many of these are multi-baggers of tomorrow. They have higher earnings growth potential. Uh, More importantly, why do they have higher alpha? Because these are small companies, and therefore there's not too much research that has happened on these companies and these industries. So there is a research arbitrage there. They are under-researched and to a large extent under-owned as well. Over a period of time, as the market matures, this under-ownership actually will change. We are seeing some of that happening already, with the retail segment actually becoming much more savvy, and more funds getting into the space. the amount of research on these companies and the ownership also will increase over time. But I believe that there is a long time period before which it really the market really becomes much more mature. There are opportunities, therefore, of pricing anomalies here, and that you can capture and get invested, and then remain invested for a period of time, a long period of time, so that the stocks multiply and you generate alpha. So which is why I said the potential for generating alpha is higher for this segment. There's also diversity in this. I think when you talk of the large caps, you're looking at only the top 100 companies. When you talk of mid caps, you're talking of the next 150 companies. So you are restricted by and large to a certain universe, which is uh, very clear and defined. Now, that is not the case for small caps, which is a very big differentiation. There is far more diversity, therefore. So from the 251st company onwards, you can invest in any company beyond that. Obviously, as you go beyond beyond, I think 700 company or something, you will get into less than 1,000 crore market cap, which is then very difficult for a fund to really invest in. So you have approximately, I think, uh, uh, about 700 odd companies, in that range. So this is a slide which gives you some numbers on the universe that is expanding, and this universe is seeing higher profitability as well. You're seeing a number of stocks getting added through IPOs, and many of them are in the small cap category as they come in. The as of the December data that Amphi uses for deciding the cutoff in terms of small, mid, and large cap, the 250th company has about 16,800 crores or thereabouts in terms of market cap. So anything lesser than that is actually considered the market cap, and that is part of the universe that we look at. This was actually 10,000 crores a few years ago. So that's the market has been growing, and the cutoff has also been growing along with that. Um, I sense that, my sense is that in July, when the new cutoffs come from the Amphi categorization, I think it will continue to be somewhere in that 17,000 crore range. Um, the number of companies between the 1,000 crore market cap to 17,000 crore market cap is about 700 odd, which was 600 in FY17. So we've added quite a few stocks to this universe in this period. More importantly, I think the profit pool is also increasing. The number of companies making more than 100 crore profit within this pool of 700 odd companies in FY23 is more than 440. And you can see that there are 200 plus companies which are making more than 250 crores profit. This is all data as of FY23. And there are about almost 100 companies which are making more than 500 crores profit, and quite a few companies, about 36 companies, which are making more than 1,000 crore profit as of FY23 in this universe. So the advantage of this kind of a fund is that you can invest in a large universe. It's a very diverse universe with multiple sectors, and the profits are really increasing for the better run companies. So and this is expected to continue as well going forward. So the stock universe is seeing addition in terms of number of stocks. It is seeing growth in profits, significant growth in profits, and also in terms of market cap. However, having said that, the universe is large. I think stock selection is very, very critical. All stocks don't perform, as we know. You need to really look at, like I earlier mentioned, some of the key aspects, which are scalable opportunities, which means there should be a long runway of growth, and the business should be scalable. These should be run by competent managements and promoters. and there should be good governance practices, which if it is missing, obviously, the small caps may remain a small cap and may not get re-rated over time. So governance is again very important, and I think that is linked to the point I made about the promoters and the integrity and the drive that they bring to the table. Of course, balance sheets are important. You can get caught in companies which don't have a great policy or behavior in terms of capital allocation, and you may go get into bad balance sheets, and then that can spoil your returns over time. So that is extremely important, especially given that these are small companies. You need to understand their behavior, their thought process of the people running the show, how they behave in bad times. You need to get that feel before you really get invested in a big way. Also, I think modes are important. Like I earlier mentioned, you can find niche segments, you can find emerging industries, you can find businesses which are gaining market share from the unorganized space. You can find lots of spaces within the universe which can have or which will have the potential to grow faster and can create value for you. So these are the companies, these are the type of companies that we are trying to identify, and once you buy it at reasonable valuations, you should remain patiently invested over a long period of time. And our endeavor is always to look for companies where you can remain invested as much as possible. So our churn ratios therefore are lower. I'll speak about that in a minute. Smaller companies generally tend to do well during a recovery, and that is what I started my presentation with. We are looking at growth. We are looking at earnings, therefore growing at a higher, faster pace as we go forward. And in times in the you can see the chart there. The period between 2004 and 2007 has been highlighted. The period between 2010 and 2012 has been highlighted. Those are periods where the earnings growth had picked up fairly significantly. There was growth in the economy and tailwinds. These are times when these are characteristics of markets where the small cap segment really does well. Smaller companies, therefore, behave much better and deliver higher returns during these periods. So earnings recovery and earnings growth is something that you need to track if you are a small cap investor. And I think it's important to note that we are looking at better trajectory of earnings as we go forward, as I earlier mentioned. Coming to the portfolio strategy, the small cap fund is managed by myself and I'm backed by Vihang. The benchmark for this fund is the Nifty Small Cap 250 TRI Index. The inception date for this fund was 12th May 2014, so it's about 9 years old now. One more year and it will complete 10. Hopefully, we will remain in that. The 9 year record has been reasonably good, so hopefully we can continue with that on a 10-year basis as well. The AUM size is about slightly more than 9,000 crores now. We follow a bottom-up stock selection process here, given that these are small companies, and you need to really look at each company and analyze them before you buy, and each company comes into the portfolio based on its own merit. So it's a completely bottom-up stock selection process here. It's a very actively managed portfolio, so to that extent, I think you will see us, having significant differences in terms of exposures to industries versus the benchmark. This is not something only this is not specific to the small cap fund, but across most of the funds that we run, we are active investors, and so we don't shy away from taking bets outside the benchmark. But in this portfolio, you will clearly see, stocks that are outside the benchmark, and exposures to sectors, significantly different from what is there in the benchmark. It is a predominantly growth-oriented portfolio because that is what you are aiming to achieve, higher growth and therefore higher returns. But the focus is on buying growth at reasonable price. We are not in the high growth end of the market, so we are not into the extreme growth part, nor are we on the extreme left, which is a pure value. We are somewhere in between, so we look for growth at reasonable price. There is a exposure to mid cap, so the regulation states that you can have up to 35% in mid caps and non small caps in the portfolio. Currently, I think as per the last market cap categorization, we are at about, I think, 70% in small cap and about 30% or about 27% or so in mid caps. There are a couple of stocks which have moved from mid caps to large caps, and we've remained invested there. But that is purely because the stocks have appreciated and we do like them, and we've remained invested. Therefore, so the 30% mid caps or the 35% mid caps actually are meant to provide some more stability to the portfolio, because the small cap part of the market can be volatile and can and you need some cushion, some stability, which is provided by the mid cap part and of the portfolio. We have a relatively low churn or low portfolio turnover, and that is because we are long-term investors. We believe in buying companies which can do well over long periods of time. So as much as possible, we would like to own companies which we can hold for long periods of time. So if you analyze the portfolio, if you take the fact sheet of the last several years, you would find many common stocks over the years remaining in the portfolio, and we continue to hold them. Like I mentioned, there are two or three which have really appreciated. From I think one or two which have moved from small cap to large cap, and I think that is something that we would always want to achieve. This is the portfolio positioning. I think we are far more tilted or skewed towards the industrial side, the cap goods, industrials, the entire cyclical space. We are overweight, therefore, on the cap goods, industrials, and manufacturing space. Consumer durables, we are slightly overweight. We are underweight banks. We are slightly underweight software. But there are some, small cap stocks that we've added, and hopefully it will, we will probably move to a neutral part soon. Realty, we are overweight. And there are many other small sectors where we have invested early, and we remain invested, where the index weight would be lower. As I mentioned earlier, we've been invested in many of these companies for long periods of time, and therefore our portfolio turnover ratios are generally lower. And this is not for only this fund, but most of our funds have lower churn ratios. We will continue to, our endeavor would be to maintain that going forward as well. That's what I had to share in terms of presentation.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.